Welcome back to part two. Today we're going to talk about the three approaches: asset, income, and market methods. Now, I'd probably want to establish why the valuation matters beyond the numbers. So today we're going to explore these three fundamental approaches that I mentioned, and they form the backbone of all the valuation work. It doesn't matter what type, all the valuation work. Think of these as three different cameras photographing the same subject from different angles. Each reveals something pretty unique, okay? So the first and the most common use is the asset-based approach. And what is that? The asset-based approach asks a simple question. What would it cost to recreate this business from scratch? Or what could we get if we liquidated everything? This is the most relevant for asset-heavy businesses. We're talking about, let's say, manufacturing or real estate or natural resources. You're essentially doing some very sophisticated accounting. You're taking the balance sheet values and adjusting them to fair market value. So for example, the book value of a factory might be $1 million after depreciation, but its replacement cost could be $12 million. So its liquidation value might be only $2 million. The asset approach, they force you to confront these realities. But there's a limitation though. It completely misses the intangible value. Things like customer relationships, brand equity, intellectual property, network effects, and an end dimension model. None of these appear on traditional balance sheets, yet they often represent the majority of the enterprise value in modern businesses. So I have used the asset approach primarily in very distressed situations where we are genuinely considering liquidation of that particular business or as a flow value in negotiations. It's also useful in valuing holding companies and investment portfolios. But for operating businesses generating returns above their cost of capital, you need other approaches. So let's talk about the next approach, which is more like the income-based approach. The income approach is where the finance theory, they really shine, right? The core principle is a business is worth the present value of all future cash flows it will generate. This is elegant in theory, but very complex in practice. You are going to be making assumptions about revenue growth, margin expansion, capital requirements, discount rates, all extending years into the future. And the most common method here is the discounted cash flow method. You project free cash flows, you determine an appropriate discount rate, and that discount rate, it reflects your risk, and then you calculate the present value. I like DCF because it forces disciplined thinking about the business model. To project cash flows, you must understand what drives revenue, what is a cost structure, what reinvestment is required, how sustainable is the comparative position. You need to know all of those factors that play in. But here's where people go wrong. They confuse precision with accuracy. I have reviewed DCF models with projections extending 15 years, calculated to 2 decimal places. There's false precision, by the way. Beyond 3 to 5 years, you're really capturing terminal value, which is where most of the valuation sits anyway. The discount rate is critical. It should reflect the risk profile of the cash flows. High risks, higher discount rate, lower present value. The weighted average cost of capital is a standard approach for enterprise value, but there are nuances around capital structure. There are nuances around market risk premiums and risk size premiums as well. One insight from my experience, sensitivity analysis matters more than the base case. I want to see the valuation under different scenarios like optimistic, base, and pessimistic, because this gives me a range which is more honest in a single point estimate. And there's a third approach, by the way, other than the asset base and the market base, is income based. The market approach says what are comparable businesses trading for. This is anchored in the wisdom of the markets, a collective judgment of thousands of people, of buyers and sellers. Public company comparables give you trading multiples, EV to EBITDA, price to earnings, price to sales. You identify similar companies, you calculate their multiples and apply them to a subject company with appropriate adjustments. Your transaction comparables, they use actual M&A deals. What did buyers pay for similar business in recent transactions? And this often yields higher multiples than public comparables because of control premiums and synergies. The challenge is finding true comparables. Two software companies might have completely different business models. One is subscription SaaS, and the other one is a perpetual license. One has 80% gross margins, the other has 50%. They're not comparable despite being in the same industry. I've seen people mindlessly apply median multiples without understanding what drives the variance. A P ratio means nothing without understanding growth rates and capital efficiency. So here's my framework. The market approach is most reliable when you have true comparables and liquid markets. For unique businesses or in illiquid private markets, it's a sanity check, but it's not the primary method. So in closing, you rarely use just one approach. I generally use to triangulate, look at multiple approaches. If your DCF says 100 million, your comparable says 70 million, your asset value is $50 million, you have a conversation to have about what is driving the differences. And so what we'll do right now is in part 3, we'll go deep on the fundamental discounted cash flow modeling, building it from first principles and understanding the key drivers. And then we'll build up to the other methods as well. So hope to see you in the next session on part 3, which is a deep dive on DCF. Take care. Bye-bye.